The first thing is you have to understand that you always pay interest. Whether you finance, which means you've borrowed, right? Or whether you pay cash. Now, why are you always paying interest? When you finance, it's obvious. It's the interest you pay to the institution.
Yep.
When you pay cash, it's the money you no longer can earn, right? It's the interest that you don't earn. Money can be complicated. Let a nerd help you. We're here to demystify the complex nature of money by getting you answers from financial nerds and whiz kids. Welcome to Ask the Money Nerds, a weekly segment of the Wealth Labs podcast where we answer your most pressing money questions. Garrett Gunderson Ask the Money Nerds. People want to know where to start, how to build a team, what to do when they've got cash value. So I love this question. It's a little robust and specific, which is what I asked for. So let's dive in.
Yeah. Dylan wrote in. So we have two parts of a question for him.
Okay.
First, he says, love your work that the team has been putting out. And he's read the big three, and he's referring to as killing sacred cows, what would the Rockefellers do, and budgeting sucks. I love that.
Okay, well, let me just throw this
out. The
big
three.
I'm going to say this. I've got the money tree.
Yes.
Portal to Genius that I was a co-author. 5-day weekend that I was a co-author.
Yep.
So just throwing that out there.
And then coming on a date that has yet to be determined, Win Then Play.
Keeps getting delayed. I keep having insights and research. So what are we going to do?
It's going to be exciting once it launches.
By the time it's out, it'll be 10,000 hours of my time into it. It's fine.
It'll be good though.
Yeah.
Okay. Are we ready?
Yeah.
So Dylan wrote in and he's wondering, with the cash flow banking system, what is the optimal way to utilize the cash value once you get started, once you know your investor DNA? Like, you have the cash, now what do you do with it?
Okay, so first, it's important that we understand our cost of money. Cost of money is your highest sustainable kind of safe rate of return that you can earn or that you have to pay to get to money.
Okay.
That's cost of money.
So how does someone determine what their cost of money is?
Okay, so let's look at cost of money, because there's a pretty important concept that a lot of people don't know, but if you understand it, life gets better. Okay? The first thing is you have to understand that you always pay interest. Whether you finance, which means you've borrowed, right? Or whether you pay cash. Now, why are you always paying interest? When you finance, it's obvious. It's the interest you pay to the institution.
Yep.
When you pay cash, it's the money you no longer can earn, right? It's the interest that you don't earn.
Yeah.
So understanding your cost of money is important, because let's say that it's an American Express card at 17%. Anytime you don't pay that down, the dollar you spend somewhere else really costs you $1.17. Still, but like, I'm just going to have you you were a teacher, so this is great. So understanding
it's only because I've heard it 100 times.
Thankfully, you came along. You gave my wife a little bit of a release that she doesn't have to hear this 24/7. Now she gets a part of the time. You get a part of the time because I'm a financial nerd.
We'll do a 50-50 split. I'm okay with that.
So cost of money is really important. So let me say this. If I'm willing to lend you money at 0%, how much do you want?
As much as you can give me.
Why?
Why? Because it's not costing me anything other than...
You can earn more than 0% on it.
Right.
Right.
Yeah.
So when you understand your cost of money, then it lets you know whether you should leave the cash in your cash value. My cash values that I started 21 years ago, are like 5.32%.
Yeah.
I don't pay tax on that either. So if I were going to pull that money out to invest, I probably got to earn like 9% by the time there's taxes and fees and that kind of stuff. And I have no active responsibility for my cash value right now. It just happens on its own.
Yeah.
It can't go down. It's got a minimum guarantee, right? It's got those tax benefits. So if I'm going to take it out, it better be pretty certain that I'm going to do better. So where might I borrow that? Well, maybe to pay off a credit card. That would make a lot of sense, because if it's costing me more than I'm earning, let's go ahead and do that. Maybe it's to buy a business, because now I can buy it at a discount because I can have the cash. Or this cabin, I was able to get a discount because I had cash from my cash value that I could access within. I had it, together, I think 9 days after I signed the agreement or something. So I was able to get this over the two other people that were going for it, right? And I got it for a little bit of a discount.
Yeah. Because you had the cash.
Because I had the cash. So that made some sense. Or I put in a TV studio because I didn't want to go through the huge process of getting a loan or tapping into my cash that was just my, operating capital for my business. Or I use it to put down payments on real estate, because in the real estate I could create cash flow, and I could pay it back. So those are examples, but you really have to look at, like, what are you earning versus what are you paying? And I met this guy. I was speaking at an event in Aspen or Breckenridge, or one of those resorts in Colorado. And he was saying, hey, he just uses his cash value, and Bank of America gives him a 3.2% interest rate loan against it. He doesn't even borrow from the insurance company. And they just have a line of credit, kind of like brokerage accounts do. I usually just borrow from my cash value, but that might cost you a 5% interest rate.
Yeah.
Now your money stays in the account earning interest, and they give you their money. It doesn't impact your credit. You get to choose when you pay it back. If you don't pay it back, it subtracts from your death benefit. So it has pretty favorable terms, and I've used it many times over the years.
So someone who does end up taking money out, they determine if they want to pay it back in 3 months or 3 years, or
yes. My co-author of Budgeting Sucks, Dale Clark, when he borrows, he has a very specific payback schedule that automatically deducts from his account every single month.
Okay.
And he charges an interest rate that he would have had to pay if he went and got the money in any other way. So it's a little bit, he pays back a little bit higher than what the insurance company's charging him. So there's that.
All right. Anything else to add for part 1 of Dylan's question?
No, just be really careful with where you're allocating that capital. Make sure that, if you can make money on the buy, because it's a distressed situation, or you can cash flow from day one. Those are the things I'd be looking at.
Okay. And determine your cost of money. That's really important on the front side of everything.
Cost of money. Cost of atrocious handwriting is what this is.
You definitely were not a teacher.
I'm so disappointed looking at this right now. If she watches this video, she's embarrassed because she really tried.
I taught him better than that.
She did. If you see how I hold a pen, it's disgraceful compared to what I was taught in school.
Uh-oh. I haven't paid attention to that.
The
teacher in me won't correct you. Okay. Part number 3, Robert Kiyosaki and yourself preach about starting to build your team. Robert says it just takes time to find the right team members to work with. What's the interviewing process, or how do you first find the right team members to help you grow? And how do you set up a team?
Well, here's how I did it.
Okay. There's more questions, but we'll address these first.
When I was in college, I had a professor, Stephen Harrop. He was a money manager, managed $5 billion in municipal bond funds, then decided he would give 25 years of service by being a teacher. So I just found out what his interests were, and I started to work out with him. Then I got to know him. I got to ask him questions. We'd go for yogurt afterwards, and it was like that was the first part for me. The other thing that I did to build a team was, I would go and pay to go to events that were for attorneys, because I want to find an attorney. I'd pay for events that were for accountants, and then I would show up, and then I would find out who the brightest people were. Yeah. Right. I went to this event called the Taggart Symposium, and there was a guy, Greg Barrick, who gave a lecture on charitable remainder trusts, and he was a pretty prominent attorney. And, I was just a kid in my, early 20s, but then I just found a client that would be good for him, reached out to him and said, hey, is there any way that you could help with this? And he just liked that I was young. So he said, sure. So he actually became my attorney, but he was going to eventually retire. And, a lot of my clients were really small clients compared to the ones he was working on. He helped with Walt Disney's estate, for example. So I said to him, who's the up and coming guy? Who's the guy? And he goes, here's this guy, Andrew. He's the guy. And we were similar ages. He goes, you guys can grow together. And Andrew's been brilliant, you know. And Andrew then eventually went on to be part of the facilitation of the Legacy Trust for the Utah Jazz, the transaction for the Houston Rockets when they sold, like him and his partner. I mean, one of the biggest, fastest growing firms in the entire West Coast. I mean, so that's what I did. I just used what I could. I just looked for ways to build value. I went to events that were for continuing education for those industries. And then, the way I would interview them is I just had a little red memo pad, just a little red, just like those little tiny ones that flip like that, I just wrote my questions. What do I want to know? And then I bought a course called Leap, and I just wrote tons of notes on that. I'm like, ooh, I want to know more about this, and who would know about that, and who's the best. And I would just start asking people when I would go to these events. And because I was so curious, and I was just willing to have the conversation, and I ended up meeting a couple business partners, because two guys that were just as curious as me and as loud as me and asking questions all the time, we ended up getting together and doing study groups. So, I mean, everyone has their own path. The fastest path I could find is wealthfactory.com/private, because we have an accredited network and a wealth architecture network, which are full financial teams. And we're consistently interviewing, and we have a 42-question application, and it's not 9-month interview process. And they've had to work with us or our coaches on our own stuff before they ever see one of our clients. And so I really pride us in what we've built there. And that would be a good way to help.
Okay. So now once those people have been identified through whether you're meeting them at events or all of those other ways that you suggested, how do you introduce them to each other? do you think his team members should already know each other and have some relationship already? Or
okay, that's helpful because my first accountant and my first attorney did not agree with each other, and so they just did their own thing, right?
So how do you make sure that they're like working in a cohesive?
Well, I recommend
unit?
everyone has at least one call a year with their whole financial team. And before you make any decisions, it's important to have a financial kind of what we call a financial architect or financial point person that helps coordinate that entire team. Otherwise, it could be very chaotic and they go and do their own things. I mean, that's why Wealth Factory exists. I mean, this sounds like a commercial all of a sudden, but I get how complicated it is, and that's what we built. You know,
because, you know, if you're a business owner, you probably have 5+ people on your team between the tax attorney, the accountant, the CPA, you know, everybody else that you've listed. There's a previous video where you've really dove into that a little more deeply, but just making sure that they have similar philosophies and they're working in unison. Like we want, when you're building a financial team, you want them to work in tandem. You don't want individual pieces.
We have our 20 bullet point list. We call it the common premise to a committed declaration of it was complicated, so we renamed it New Rules to Get Rich.
Yeah.
and then it's the 20 points that they have to subscribe to.
Okay.
Then I'd have them read Killing Sacred Cows. A lot of people, you know, and feel free, give those professionals the link, wealthfactory.com/megakit. Let them have Killing Sacred Cows at no charge. And that's a great test. If they agree with that book, that's a pretty good sign, because it's pretty confrontational against some of the myths that are out there that a lot of the financial professionals would disagree with, you know?
Yeah. I had a friend do that where she was starting to learn about, or just building her financial literacy. And she's like, I don't know if the 2 people that I have on my small team are even in agreement with this. So she actually gave them a copy of What Would the Rockefellers Do? He read it and he was on board, and she just had more confidence in who that person was. So you can do it on a small scale, but also on a larger scale.
That's 3 things in a row. But anyway, because it is.
But they are helpful resources. Right. Yeah.
All right. Ask the Money Nerds. Ask your questions. We'll give you the answers. And go out there and have a great day.